With thousands of index funds and ETFs available to choose from, you may be wondering, how many index funds should I hold in my portfolio? Some people say that one is all you need, while others argue that you should hold between 5 and 10 funds for a complete portfolio. However, personally, I think that the number of funds you own depends on a lot of factors. First of all, the amount of index funds you own will depend on your preferred geographical diversification and how diversified those index funds are. If you invest in well-diversified funds, you may only need one or two. For example, you may choose to invest in the entire world by buying a global index fund, such as the Vanguard FTSE Global All Cap Index Fund, which invests in over 7,000 companies in 40 different countries from both developed and emerging markets. In that case, a single fund would get the job done. Or you may want to achieve the same level of global diversification by combining a developed world index fund and an emerging markets index fund. Pretty simple, right? Now, here is where it gets interesting. Although these funds invest in all the markets in the world, they do so by following a market cap weighting approach, whereby they invest according to each country's market cap. For instance, the stock markets in the United States currently account for nearly 60% of world stocks, followed by Japan, then the UK, and so on. So if you were to buy a global index fund, 60% of your money would be invested in the US market, then about 6% would go to the Japanese market, 4% to the UK market, and so on. However, you may not agree with these market weightings and may want to buy index funds according to your preference and your opinion as to which geographical region is going to outperform in the future. For example, if you thought the UK is really undervalued, then there are lots of opportunities there, and also believe that the US is perhaps too expensive, you may choose to allocate 40% to the US market instead of 60%, 10% to the UK, and so on for the other markets. Therefore, in that case, you need to create your own tailored portfolio by investing in single funds that target each of these markets according to your strategy. So you would end up with quite a few. The main advantage of constructing your portfolio this way is that you have control over how much to invest in each market. However, the disadvantage is that you need to monitor these investments regularly to ensure that your asset allocation still matches your goals. Because over time, some parts of your portfolio will perform better than others, and the good performing assets will become a larger part of your portfolio, while the other ones will make up a smaller part. If this happens, you may need to rebalance your portfolio to go back to your original asset allocation, which requires quite a bit of work. So this approach could see you with tens of index funds, which adds a lot of complexity and decision making to your process. Which is why I think it's best to avoid all of this work and build a simple global portfolio with only one or two funds that track all the markets in the world. That way you wouldn't need to worry about rebalancing your portfolio or setting up direct debits for each fund and so on. This is the best approach for first-time investors in my opinion, as it simplifies things massively. Nevertheless, another factor that could impact the number of stocks you end up with is your preferred strategy. For example, some people may not want global diversification and may choose to gain exposure only to the UK market, for example, because perhaps they want to earn a dividend income from their investments, and UK stocks are great dividend payers. In that case, a simple FTSE 100 index fund which tracks the largest 100 UK companies would get the job done. Others may decide that the US market is the place to invest, and they may allocate a portion of the portfolio to an S&P 500 index fund as well. Therefore, if your investment strategy was only centered around the UK and the US, you would only need one or two funds that track these markets. But that's not all. It's also worth noting that different countries have multiple indices which track many kinds of companies from different sectors and industries. But before we continue, do me a huge favor and subscribe if you're getting any value from this video. It really does help small channels like mine. Thank you. For instance, in the US, the S&P 500 tracks 500 of the largest US companies, as I mentioned earlier. But the Dow Jones Industrial Average includes 30 of the main blue chip companies in the US, while the Nasdaq captures mostly tech companies. So the Dow and the Nasdaq aren't a broad representation of the US market like the S&P 500 is. Therefore, it's important to pay attention to these things, because if you only invested in the Nasdaq, for example, thinking that you would hold a big portion of the US market, you would miss out on a lot of good companies. Similarly, in the UK, there is the FTSE 100, which tracks the top 100 UK companies, but there is also the FTSE 250, which consists of the next 250 largest companies and includes small and medium businesses too, not just the large ones. So again, if you invested only in the the FTSE 100, yes, you would gain exposure to the top British businesses, but you would miss out on a lot of growth companies in the FTSE 250, for instance. The idea is that it's important to understand the difference between the multiple stock market indices and the kind of companies and sectors they include, because this also impacts how many funds you end up with. One other important aspect that will determine the number of funds in your portfolio is your preferred asset allocation. In other words, are you planning to invest only in stocks, or do you want some bonds or other asset classes in your portfolio as well? If you do decide to diversify across multiple asset classes, the number of funds you end up with will yet again increase. Let's assume that you decided on an asset mix that looks something like this. 40% could be allocated to the US market through an S&P 500 index fund, 20% to the UK market, then 10% invested in Europe in something like the Vanguard FTSE Developed Europe excluding UK ETF, 5% in a Japanese fund like the Japan Stock Index Fund, and 5% in emerging markets, for a total of 80% stocks. The remaining 20% could then be allocated to a global bond fund, such as the Vanguard Global Bond Index Fund. However, as we saw earlier, we could also build this portfolio by using fewer funds. For instance, 80% of the portfolio could go to the FTSE Global All Cap Index Fund for the global equity diversification. And if you wanted to add some bonds too, the remaining 20% could go to something like the Vanguard Global Bond Index Fund. In fact, you could simplify things even more by investing in a ready-made portfolio, like Vanguard Life Strategy funds. For example, I could choose the Life Strategy 80 and that's it. I wouldn't have to worry about anything else. At the same time, you may also want to invest in small cap stocks or factor ETFs to try to gain higher returns, a REITs fund perhaps, a commodity ETF, and so on, which again will have an effect on the number of funds you will own. But the bottom line is that there is no magic number of funds that you should have in your portfolio, and more doesn't always equal better. In fact, investing in tens of funds doesn't mean you have a diversified portfolio. A portfolio with 15 funds that overlap is not diversified. Now, in this video I talked about traditional index funds, which are based on a market cap weighting approach. But there are other funds that you may want to consider, called smart beta funds, which aim to give you substantially higher returns. So check out this video next to find out how you can beat the classic Vanguard index funds with a different style of investing.